Welcome to Impact Farming, where we introduce you to the people and ideas that will have a massive impact on your farming operation. Brought to you by Farm Marketer. Sit down, start the engine, and let's roll with today's show.
So welcome to the brew house. This is where the magic happens.
So similar to you, Tavis, we've become a real recipe-driven industry. So part of that recipe for us is starting with a really good high-quality seed.
We want to make sure that pretty much every single kernel that comes into our malt house is ready to go to work.
That's going to create a better yield for us, but a much better quality barley kernel for you at Freehold.
Cheers to keeping it local.
Cheers, guys.
Hello, everybody, and welcome back to another episode of the Impact Farming Show. Today, we have a great guest with us. We have Jason Dobbin from MASC, and he is joining us as part of our risk management series to speak about the Livestock Price Insurance Program. Welcome, Jason.
Hi, Tracy. Thanks for the invite.
I really appreciate you coming on. This, I feel, is a program, and you can correct me if I am wrong. I feel a lot of producers don't take advantage of it, and I have heard from others too. There's a lot of confusion around this program. It seems so complicated until you get it, then it's pretty simple. Is that hitting the mark?
I think so. I think that's a fair statement. I quite often see it as well. I know when I first came on board in 2014, when we launched in Manitoba, some of the first meetings that I saw of this program, I was like, "Oh man, I'm going to be coordinator, and I don't know if I can fully grasp this." But yet, it's so simple once you get into it, and that's the trouble. I think that we need the producer to find out the ins and outs and the workings of the program to realize that it is a very simple program once you're exposed to it. So hopefully with today's meeting, we'll shed some light on how simple the program is.
Excellent. I'm looking forward to it. On our farming operation, we buy price insurance every year. It's part of what we do for our farm to manage risk. We do agri-invest, agri-stability, and calf price insurance. So I feel it's very important. I'm excited to have you. So why don't we dive right in and let's do a quick 101 where you explain what the program is, and then we'll get into some details and go from there. Sure.
Okay. I would say that the goal of the program is to provide risk mitigation for producers. So we're essentially, and I include myself because I'm a producer as well, that we're price takers, and we essentially are that. That's what we are. We're price takers. So what this program is designed to do, because there hasn't been any real risk mitigation programs, in my opinion, that have helped the producers in Western Canada against price risk, and that's what we're here to do. We're to provide that protection. It was developed out of BSE. One of the things that I think is important, very important for producers to understand, is that this was developed by beef producers, hired Gibson Capital private firm, developed by beef producers. And it's not some government bureaucracy or some government bureaucrats that when we hear it in the field about criticisms, you got to realize this is producer designed, producer developed, and then government stepped in to administer. So, that's the main goal, is to provide risk mitigation for us as price takers.
Okay. So quickly to clarify, because I thought it was only beef, and then I was doing my homework for this episode, and is it other livestock as well?
Well, we also have protection for hogs, so it's beef and hogs. So
okay.
Primarily our portfolio though is that on the beef sector.
Okay. Good. I just want to clarify that. So who administers the program, and is it available in all provinces?
So this is the Western Livestock Price Insurance Program. So it's the Western Canadian provinces. So Alberta, BC, Saskatchewan, Manitoba, the 4 Western provinces. In Manitoba, MASC is the administrator. In Saskatchewan, it's SCIC. In Alberta, it's AFSC. And in BC, it's the Ministry of Agriculture. Okay. So it's the first time there's ever been with conjunction of the federal government. So federal government and 4 provinces in a program like this, it's the first time it's ever been done. And I'm kind of proud of that, the fact that we're showing that it can be a cooperative approach.
Okay, perfect. Ontario doesn't have it?
Not as of yet. There is proposals. You always hear proposals that this could be a Canada-wide program someday, but at the moment, it's just the Western provinces.
Okay. So I don't know if I want to go here quite yet. Maybe we can touch on it, and then we're going to get into some of the common questions I hear that I have from producers to ask you about. But sometimes when you talk to farmers, you hear them go, well, it's not worth it and it doesn't pay out enough. But I really want you to frame the goal. And to me, the goal of this program is like house insurance. You buy house insurance in case your house burns down. You hope it never happens. And correct me if I'm wrong on this. With calf insurance, you're buying this as a floor so that you know the floor price on your animals in case all Hannah breaks loose and prices go down the drain. You just hear a lot of farmers, I think they think about it wrong. And same with agri stability. Some of those programs, I think they want to pay out, but the goal is you have it there to protect yourself, and you're hoping to goodness that you don't need to claim it, right?
Well, I agree 100%. It's funny you made that analogy. Our methodology never changes. So it never changes. And when COVID first started and our premiums started to rise, and that premium, the raising of the premium was directly as a result of the volatility of the CME. There was quite a bit of criticism in the fact that, well, now that we need you, the premiums are fairly significant. Well, I made the analogy, and I make the analogy, it's kind of like going down to your local insurance broker when the house is burning down. And you're going to pay a lot more for it when the house is burning down.
Yeah.
I hear the criticism as far as you aren't paying out. So I feel I can say this as a beef producer myself, that I think we have a bit of a mentality of I'm putting money out, what am I getting in return? And if I don't get some money back, then it was a waste of time. Well, I disagree with that. I understand it, but I disagree with it, because you did get, for your premium, if you didn't get a payout, you got peace of mind, you got protection against the cash market, so you got protection as far as price goes. You got value. You got, in insurance terms, you could say your premium was earned as far as the protection that you received. If you're not getting a payout, then that means the cash market is above of what that futures value was. And that is a good thing. And when you want to start talking about the premium cost, and people might say, well, he's full of it, but we've done research where it shows approximately the premium cost for WLPIP is equivalent to that of what you pay for bedding. I don't think we even question when we go to start baling and putting up bedding, like straw for bedding, but you're going to question something that actually protects your income. To me is quite a interesting. Like I tell people that sometimes I feel like I'm it's a bit of a psychology course I'm taking, in that I don't understand the thought process behind some things that we take as no-brainers, and then one that really can help us, there is that criticism.
You know, it's so funny you say that, because in a lot of these risk management interviews I was doing, a lot of this comes down to human nature and our psychology and procrastinating, and the fact insurance is tough. Nobody likes to pay it, right? Because you don't get something. I think, and that's what you're saying, right? Yeah, I'd prefer to take that money and go buy bales or hay or heifers or a heifer, whatever the case is, because I get something. But
well, on a personal note, I mean, we have our hay insurance, and our hay insurance people criticize that as far as being too little coverage, too high a premium. But when you have a disaster like I had last year and it saves your ass, it's you're sure glad you had insurance. And with this program, what I find so interesting with this program is that how many insurance programs give you 25, 30 choices on what you can do every day of the week. You can do something different, and you could make your policy designed for yourself how you want it, from the most expensive to the cheapest. You can make your own coverage. There is so many options with this. Like, if someone asked me, you want to insure your truck, and I go in and because I got quite a few farm trucks, well, I want this one and I want to tailor it to this, without just auto-pack saying it's 500 deductible, 300 deductible. If I could make my own coverage and my own premium, I'd sure be happy. But we don't hear the criticism like that about other insurance. So I think it's just that psychology as independent producers that cattle producers are. We're price takers, and the only thing it seems like in the past that we've had to be able to control or help our income is what we're putting out of our pockets, so what we're spending. And so if we're spending money on this, what are we getting out of it? Oh, we're not getting money out of it? Well, then it must not be worth it. Well, that's that comment is where I believe they're wrong.
yeah, and that is why I'm doing this risk management series, because there are so many producers. I think as producers, we're overwhelmed. You're a farmer. I see my husband working all day long. They work long, hard days. And at the end of the day, do they want to come in and learn about every single tool they need for their farming operation? So I think there's that. And then some of them can be a little bit confusing, and you got to spend time to wrap your mind around it, right? And then again, just like you said, the psychology part, I don't know, I'm not getting anything. Let's hope for the best, right? So I'm actually glad we went here right away, because I think that's one of, you're on Ag Twitter or you talk to any of the farmers, you hear exactly like you just said, some of those criticisms. And that's really why I wanted to say, let's frame this correctly, right? Let's frame it. And then,
I agree 100%.
Yeah, so I love that you went there. Okay, so pricing. How is that determined for each province?
Well, it's not so much each province, it's the program as a whole. So the program's the same. It doesn't matter what province you're in. As far as we have a few different options that are different in each province, as far as, like, say, charging premium and stuff like that. But as far as the program itself, it's the same across the province. Nothing's different that way. So pricing is determined by the CME. Like, our pricing in Canada is derived from the Chicago Mercantile Exchange. So we're using feeder cattle futures. We're using the live cattle futures for the fed market. So we have 3 different options for the producer: calf, feeder, fed. Feeder and fed are offered year-round. The calf policies are offered from February to May. However, this year with COVID and whatnot, we're extending that to June 18th. So we have an extra 3 weeks here to take advantage of the calf product. So the Chicago Mercantile Exchange is the futures market. So we're using the feeder cattle futures. We're also using the Canadian dollar and basis. For the calf program, we have an adjustment for the price of barley, and that's just, I mean, relevant to when they're being sold in the fall. Obviously, there's a component of that barley in there for pricing. So feeder cattle, it's the Canadian dollar, the basis, and the futures. So that's where we're deriving our pricing from, Tracy.
Okay. I'm glad I asked that because I actually misunderstood. I thought there was a component that you took pricing from the local auction marts and averaged or something.
Well, and that's where we start. That's where there's a bit of, and I was going to bring it up. I was going to say there's a bit of confusion. That's where settlement comes to play.
Okay.
So we're pricing. So we're saying this is what your futures price is going to be based on the Canadian dollar, the basis, and what the CME is telling us at this point. Then when we go to settlement windows, as a settlement time frame in the fall for calf, or any time of the year for the other 2, we are going with what the actual auction market price is, the cash market price.
Yes, silly me. You look at the markets to set the pricing, and then you got to determine it from what it's being sold for. Yes.
That's right.
That makes sense. That's straightforward.
I said the other 2. I should mention that on the Fed it's Canfax data. Feeder is auction market data. So
okay, that's excellent. So walk me through this, and I'm not quite sure. Should we chat about some of the misconceptions, things that are misunderstood first, or
sure?
Yeah, let's chat about that and then roll into getting started and how that process works. I think that's a little bit more logical. Okay, so I put a list of questions together that I've heard different farmers ask, and I wanted to touch on each of those points because we reviewed them together and you said those are some of the most common ones. So let's roll into that. So actually, let's just dive right in. I think some of the misunderstandings, people think that, and correct me if I'm wrong here, but people think that this is actually based on their animals and they don't have to sell within the actual timeframes. Can you actually touch on the mechanics of how this works?
Okay, well, I think the best way to look at it is as a program of convenience, of a program that is common sense. That's what I like to say, is that this program has a lot of common sense to it, and we could go back to what I originally said. It's the producer developed. So you're looking at buying a policy. You're looking to protect yourself for, let's just talk calves right now. We're looking to protect ourselves for the calf market. So you're looking at the fall. You usually market your animals in, say, October. We'll just keep it simple. Maybe you do October, November, whatever. But let's just say you're looking at October. You're looking at these policies. You buy a policy. So that policy is protecting you for 4 weeks. So a month policy for say the month of October. Now, our requirement is that, so you bought it, say, in March. You bought a March or say April. You bought an April policy for October, okay? You're protecting yourself for a month in that October frame. Now, we won't get no rain. it's drought conditions. You are protected for October, but you have to sell those animals in September because the weather was crappy. We're saying you need to have those cattle for 60 days throughout the policy. So say you bought in March, or I said April. So you have to at least have those cattle, that amount of weight that you purchased. So if it's April, it's May, June. So April 15th, say it would be May 15th, June 15th. So after June 15th, if you had to unload them, you could. Now that doesn't make a lot of sense there, and that's probably not going to happen. But I'm just saying the technical part of the program is that 60 days ownership. But why we say that is for the reason that the criticism would come back, well, you don't even have to have cattle to buy this. You could be a speculator. No,
Right.
You have to be an actual producer to buy a policy. That's why we have the 60-day ownership. But why we don't have, you better have those cattle in October is what if something happens as far as weather. But let's say everything's working out all right till October. That's when you usually market. The idea of the program is to protect you against that cash market when you're selling your animals. However, the actual marketplace is low in October, say. And you're like, I don't want to sell my cattle right now, even though I have this WLPIP policy. So we give you that flexibility to keep the cattle to sell them in November because you think the market's going to go up. You still have this policy. You're still protected against the cash market in October. But what you do on your operation, technically with every animal, is your business. You do what you want to do. But you do have this policy for what you originally protected yourself for October. Does that make sense?
And I'm going to be vulnerable here and throw myself under the bus. Isn't it like almost a paper policy?
In some ways, yes.
Because
but you still have to have the amount of cattle that you insure, so weight-wise.
Yeah. So
the weight-wise, you have to have that weight in what you predict that weight to be in your policy. So someone will just be saying right now, they'll be saying, well, you just said that if we had to unload them, we had to unload them. And we thought they were going to be 600 pounds when they were in October. And then we had to sell them at 550 pounds or 500 pounds. Yeah, well, that's where common sense comes into play. We're going to talk to you or we'll have that discussion about, wow, this had to happen because of weather. So yes, you're right. It's a paper policy to protect the price of the amount of weight that you want to insure on your operation based on the cattle that you have on that operation. That being said, you don't have to own cattle when you buy this policy. So where the flexibility comes into play again is that say you want to buy feeders, you want to buy some grass feeders right now. You could look at our premium tables, you could look at a policy, you could buy a policy, and then you could start buying your grass cattle based on that you have a protection value of X amount of dollars. So I'm afraid to bombard you or overwhelm you with all these different angles, but my point is there's so much flexibility here. But that doesn't mean that we're allowing speculators to buy policies. It doesn't mean that you don't have to have cattle to purchase. But what we are allowing is the flexibility. So straight and narrow, you're buying a policy for when you sell your cattle. But if there's other things that go on, then so be it. You have the flexibility to work around it.
Okay. Let's do an example because I think that is the best way that I learn, and I hope our audience will feel the same way. So Tracy Burnett and my husband Anthony, let's say we have 250 cows. Okay. So go ahead.
Why don't we do an example of yesterday? Can I do an example for you yesterday?
Yeah, I like an example. I don't care which one.
Okay, so let's say for October 19th. That was a 20-week policy yesterday on May 27th. So say for $2 coverage, you would have had $1,200 on a 6-weight animal. You would have had $1,200 coverage, and that would have cost you $28.80 some cents a head for 6-weight. Okay.
Yeah.
So on 100 animals, what's that? 100. That's 100 times 1,200 is your $120,000 coverage, and it would cost you $2,800 for premium. So you got $120,000 coverage. It costs you $2,800 in premium. You're covered for a month policy in October 19th, and then backwards. So we always, whatever date we have on our tables, you go 3 weeks before. So the 3 Mondays before October 19th is your coverage. So your policy starts on, I have a calendar here, but whatever 3 weeks before October 19th is. So you have a great summer. You get to October. You are looking to market your animals. So it actually would be September 21st, the policy would start.
Okay.
October 19th. So September 28th. Sorry. September 28th is when your policy would start.
Okay.
September 28th comes along. You remember you're insured for $2. The price is $204. The average cash market price is $204. Your policy's for $2. You're not in a payment situation. Remember, you have 100. You have 600 hundredweight because you insured 100 calves at 600 pounds. So 600 hundredweight. So we get to the second week. You're insured at $2 because you remember you're insured for a month. We get to $2, or we get to the settlement day on Monday, and the price is $1.96, the average cash market price. Okay, so now you're $4 a hundredweight into a claim position. You have 600 hundredweight. You can decide, because this is only second week into your month policy, you can decide how much of that hundredweight you want to settle. You think, okay, I'm $4 in, I want to settle half. So you take 300 hundredweight times the $4, that's your payment. You have 300 hundredweight left, and you got 2 more weeks in your claim window. Next week, it's $2. Let's say it's 202. It's 202. You're not in a claim. Last week, you don't have to do anything now because it's your last week. But say it's $1.98. You're insured at $2. It was $1.98. We automatically will send you a check for $2 a hundredweight times the 300 you had left over. So 200 times the 300 hundredweight, we're going to send you a check. You didn't have to do anything because it was the last week of your policy. There's an example.
Let me go back and just make sure I understood. So that second week, we put in a claim, is what you're saying?
Yep.
Okay.
You put in a claim. You decided that you wanted to claim half of your 600 hundredweight.
Okay.
You put in a claim. You didn't have to though. You could have said, no, I don't want to claim. I'll leave it all. And you could have left your 600 hundredweight on the board till the end of the policy.
Or I could have put a claim for all of it.
Or you could have put a claim for all of it. That's right.
It's a little bit of speculating, right?
Well, and that's kind of the thing that again, on the psychology side of things that I see so often is that the way I look at it is we place the responsibility, the producer has all of the control in how they settle their policy. And yeah, you're going to see producers say, well, they say it's gambling. Well, it's not really gambling. It's more what you want to do with how your policy works out. But people will say, well, in the common question, do you think it's going to go down? Do you think it's going to go up? Well, I don't know. I probably would be in a higher paying job if I knew that. But
right?
Pardon?
Wouldn't we all?
But my point is that I would like producers to take it as they're giving us the control to do what we want. And as independent cattle producers, that's usually what we want. We want control, and that's what you have is control. But one of the things that I find now is some of the most strongest willed cowboys that I know, once they got to make a decision on, well, I'm not sure what to do here, it's almost, well, tell me what to do.
Yeah.
Which is interesting, but I don't know what to tell you, but what I'm trying to show you is that the control is in the producer. So
I think that's what trips people up, and why I've spoke to grain marketing people, sorry to interrupt, Jason, as part of this series. And here you're always hoping for an upside. Is it going to get better, more in my favor? And then you hold, and then you're up the creek. So go back there really quick. So if I'm sitting there and I'm insured for $2 a pound, right? Yeah. And it goes to $198. Okay, part of my brain would go, okay, is it going to go lower? I should hold out and I'll get a better payout. Or the other frame of mind would be, it finally dropped. I'm in a position to get a payout. I might not get back there. Do I just claim it all and then I actually get a payout?
Right.
Right there. Because I know I'm in a position right at that moment. Or I drag my feet, and this is counterintuitive, hope the price gets worse and hope I can get a better claim, right?
That's right. But here, let's add another layer to this.
Okay.
So the next layer to this is we were just talking about your WLPIP policy, but let's say you are actually marketing your cattle. And I know you, Tracy, would have the best cattle in the area.
Of course.
So you're going to market those cattle, and you're going to be above what the average cash market value was at the local auction market. So say you got $202 for your calves at the local auction market, actual cash in your pocket from the sale of those calves, but the average cash market price was $1.98. You'd be $2 a payment into the WLPIP policy. We would owe you $2 if you decided to claim. And in your pocket, you actually got $2 more than the average cash market. So your calves brought $202. The average cash market was $1.98. Your WLPIP policy was $2. So now you got $2 from us. You got $2 above the average cash market. To the guy that had maybe not as great a cattle as you and was below that average cash market price, they might have got $1.96 for their calves. And they might have had a $2 policy the same as you did for the same time frame, but the average cash market price, like I told you, was $1.98. They'd get $2 from us. They're not going to get $4 because they only got $1.96 for their cattle.
Yeah.
So that when you talk about misconceptions, that's the number one biggest misconception of the whole program, is that we pay you for what you get for your cattle. And that, I guess the best way to explain that from a program point of view, and this isn't to be sounding ignorant or anything like this, but I have a very high suspicion that if you had a policy for $2 and we were going to pay you on what you got, those would probably be the shittiest cattle you have that are going to market. You're going to get, I don't know, $1.90, and you're insured for $2, and this insurance is going to pay me for these cattle that aren't so good. Now that sounds like I'm just being realistic. I think from an administration point of view, we have software in every auction mart. That software collects the data from every animal sold. We have outlier rules that make that average. But could you imagine us trying to collect receipts from producers, trying to collect original receipts, and then trying to verify that those receipts are correct? and then actually paying them for what they like. It would be an administration nightmare. This is based solely on what raw data facts are. And what that also is interesting as from a psychology point of view for producers is it would blow your mind how many times I hear, well, that like you guys are at the lunch. You're out to lunch on what your settlement value is. Because I was at the auction mart and this was the price. If you wanted to get the data that we have, you would have to go to every auction mart sale every week. You'd have to collect the data from every animal sold. Then you'd have to take the 1 and 2 headlots out. Then you'd have to take the top 12 and bottom 12% off. And you'd have to collect all the data for between 550 and 650 pounds for calves. You'd have to make sure they're in that weight class, not 651 and not 549. You can't argue with our settlement price. You can be upset that it's higher or lower than what you thought, but it is what it is, and that's what this program is it is what it is. It is the data. It's the same as when we're providing coverage, when we're providing premium. It's solely based on data. It's not based on speculation or where we're going as far as this is what it is.
Okay, let me walk through this again. Bear with me, Jason, and I want to be really 101 and make sure this 101 brain has it because I'm running the show here.
Yeah, you're the boss.
I'm the boss. No,
as most women are.
Oh, well-trained man. Just joking. I don't believe in training. Okay, so essentially there is two things going on. We're dealing with our price insurance contract, what's happening over here, and then what happens with my animals is actually a different story, right? I want to make sure I got it.
Absolutely.
So going back there, we have that 1 month window. So let's say over here, I'm dealing with my contract over here. So I don't care about my animals right now at all. Okay? Let me walk through this just to make sure I got it. Because I think this is where producers get confused.
Right.
So I'm dealing with my contract. And exactly, I'm watching the prices. You guys send out emails. And then I decide if I'm in a claim position, when I want to claim, and all of it, how many pounds. So I'm managing my contract over here. If throughout the whole month, the price at the markets is above my $2 a pound that I insured for, then I'm never going to be in a claim position. Right?
That's right. That's right.
So then if it's above that price, then I go, oh, good. Markets are stronger than I hoped because I want to get $2 a pound. I am going to chalk that up to peace of mind insurance, just like insuring my house. So that's one scenario. It stayed above and I go, okay, thank you, price insurance program. You had me covered in case it dropped below $2. One scenario. Number two, the price does drop below. Now I'm in a claim situation. Great. I just need to decide when I want to claim and how many pounds, right?
That's right.
And then I can do that at various points. You said you don't have to do one big claim.
Right.
Okay. Let's say I have 100 calves. I go, ooh, geez, we're in week 2. It's 2 cents below. Let's make a claim. I'm going to do 50. And then I know at least I got a claim on 50. And then if it goes down again, I can claim on the final 50. Or if it goes up, then I'm not going to claim on 50. Make sense?
Yeah, no, you're right. I guess technically I'd say, well, you're going to claim on weight. So you're going to take your 50 animals and decide how much of those 50 a weight you want to claim. But yeah, you're right. That's right.
Okay. And again, I understand high level on the program, and I'm going to be a bit vulnerable here and put myself out there because I think it's this nitty gritty that tends to trip a lot of producers up. So,
well, I think it's that. Yes, they don't understand that like a lot of producers I see don't necessarily at the beginning stages, they didn't know that they're actually protected for a month every policy you buy. And you could buy as many policies as you want. So say each policy has to have 100 pounds. So remember you had, and this is ridiculous, I know, but you had 600 hundredweight. You could buy 600 policies to cover your operation, and you could buy 600 policies at so many different coverage levels and premium levels. It would be whatever you want to do. And I know you're not going to buy 600 policies, but what I'm saying is you could buy 20, you could buy, and you could have them overlapping, and you could have them running at the same time, and they could be differing prices and coverage. And that's what I mean by you could create your own coverage and your own premium.
Okay. I know Anthony, because he takes care of this for our farm. He usually splits it into and buys in 2 different groups.
There you go.
That was one of the things. Okay, we'll come back to our actual animals in a little bit. Let's touch on the contract. So you don't have to buy for all your animals, right? At all. Let's just say, see, we're trying to get a price insurance. And is this where a smart producer would go cost of production and go, you know what, I need this much money for cost of production. So I'm going to insure 100 animals to make sure that if it goes below $2 a pound, I get a payout and I can use that for X.
Well,
right?
Yeah, that's where I say it's absolutely could be. You can look at it a few different ways. You could look at it as the just basic insurance. The higher the coverage, the higher premium you pay, the most likely you're going to be paid out, more likely than at the bottom coverage with the lowest premium. However, if you want disaster insurance, like say right now at $1.80, if there was a wreck to happen, it's at $1.95 a hundredweight. So $1.95 a hundredweight, it costs you like $10, $11 to insure, to make sure for a BSE type event. Is that going to be the same as you paying $689, like $1,248 a head? It's going to cost you $40 a head. No, yeah. But it's your operation. And when I say that, there's about 12 different things in between. No, there's more than that. There's probably 30 different choices you have between the bottom and the top, what I said.
That's what I like. Yeah.
It can be tailored to you exactly. But what I find, everyone looks at the top coverage. Everyone looks at what the top coverage premium is. Oh, it's too expensive. And then they don't take the time to go down a little bit. Like to go down a little bit and look, oh my God, for $2 it could cost me $4. And that's pretty good. They look at it's $210 and it's going to cost me $680. With COVID and that, we haven't hit this year, but last year you could have insured your cows. It would have cost you like $3 a head, $4 a head. And you're over that $1,000 mark for those calves. And any producer that tells me that it was too expensive, it's a no-brainer to have disaster insurance at least.
Yeah. So that you know your absolute floor. You've said it. No matter what happens, you are getting $1,000 a calf, if that's what you pick, on X many numbers. You just can make sure you can guarantee your income.
Well, you're getting $1,000 against the auction mark price, yes. As far as in your pocket, it depends on your type of cattle and when you sell your cattle at what price. That's again, we're back to, we're not paying you for what you get for your cattle. We're paying you for what that average auction mark price was compared to what you insured. If you get above the average cash for your cattle, great. If you get below, we're not paying you for what you got below that average cash market.
So that goes, okay, we did our cash, or we did our policy here,
yeah,
and we covered that. So now let's go over here and talk about my animals.
Right.
It is that time period,
Yeah.
October, and I have 100 calves. I sell them for more than $2 a pound. You don't care.
Right.
I sell them for less than $2 a pound. You don't care.
Right.
You don't pay. What you're saying is you don't pay because I have that policy for $2. You don't go, oh, you made a little less at the auction mart. We're going to give you here.
No.
What happens to my animals is totally different, and my policy is over here.
So
right?
you know that intuitive thing that you said before, as far as, geez, you're kind of hoping that the market drops for your WLPIP policy.
Yeah.
Well, that would be crazy to think that you would want that for your operation, right? Like, so what this is telling you is that we're paying you on what it is. This is what it is, and that's what we're going to pay you. But what this is actually doing is making you want to get the most money you can for your calves. So we're paying you for reality, and then it's not affecting your operation for your marketing whatsoever. And what we're also not doing is handcuffing you and saying, you better sell in October because you bought a WLPIP policy. We're not doing that. Can you imagine? Like, you better sell now. You better sell now at a shitty price because you bought a policy. How that would go over?
Yes.
That wouldn't go over too good. You can do what you want.
That's where I continue. And am I right in what I'm saying?
You're 100% right.
Because I think that's what people don't understand about the program. They are connecting the policy and the actual physical animals.
Right.
But they're separate. Whatever I do over here doesn't have anything to do with my contract. The contract is over here, my animals here. Now, just like you said, I was going to sell in October. Sorry. Those are the situations. Whatever happens to my animals, I sell in October. It happens. But I'm a producer going, oh my gosh, it has been a drought all summer. The cattle auctions are absolutely flooded with animals. They're not paying any money. I think I'm going to hold my calves till November, or I'm going to feed them till February. So I'm making the decision to market my animals based on common sense, watching the markets, whatever it is. So my animals are over here. If I don't sell them in that 1 month period, you guys are still handling this over here, right? I don't have to sell those 100 head. I'm still managing my paper contract here. And if it drops below and I make a claim, I still get a payout, regardless of whether I sold those 100 animals in that time period, right?
That's right. That being said, the theory is you sell your animals in that October time frame, you're probably going to be at an average, and we're going to be paying you for so you sell. The theory is you're trying to match the policy for the time frame that you sold them for. You sell them for. So when you sell, if the cash market is below what that average cash market price, like if your animals are selling lower, we're going to top that up because your time frame you sold, you took a price decline, and our policy is going to reflect what it actually should have been. So that's the theory. But you are able to do whatever you want to do.
Okay. I think, do I have it straight?
You do have it straight.
Okay. Good. I wanted to make sure. And again, I'm okay throwing myself under the bus and looking silly if I don't understand, because I'm going to guess I'm not the only one.
Well, no, you're not. And there's so many different scenarios you can work out here, but the point is there is a lot of flexibility for the producer to do what they want to do. And it always a lot of times comes back to accountability. Well, if there's so much flexibility, there's room for abuse. I assure you, there's not much room for abuse in this program at all.
Okay. Okay, so thank you for walking me through that. I didn't intend to really get into that detail, but I think to me that might just be the most beneficial part, I'm going to hope, of the interview, because I think that's where people get mixed up, is in those two parts.
Absolutely. The biggest thing is, I can tell a producer within the first sentence or two sentences, I don't buy a WLPIP policy because I always get above what the market's doing. Okay, so you're the greatest cattleman in the world. Good for you. But you're talking pretty silly here. Then if you're above the average market, then you should buy a policy so you're protecting yourself against all the other people that are below the average cash market. You're going to get paid from WLPIP every time, and you're going to get paid the most out of your best cattle. That being said, the guy that says, "Oh, it's probably for Jim down the road that's got all those shitty skeletons there, he's going to sell them and make money on the insurance." No, he's not, because he's not going to get paid for what he got for those animals. So,
right. I want to be a good producer and have the best animals to make the best amount, and I'm going to have my contract over here.
And take risk mitigation.
And take risk mitigation.
And I'm going to sleep at night, and that premium is going to be earned because I can sleep all summer. And Trump's not going to affect me as much because, or listeria, or you name it, COVID, because I have a policy.
You know, I love cattle farming, don't get me wrong, but it always seems like there is absolutely something. The something can be big, like BSE, COVID, goodness knows, like those crazy things. But there always seems to be something going on. And to me, I like it because it's that peace of mind, right? It's that floor price on a certain number of animals.
And it's up to you. It's up to you to decide what you want to do. Like, it's not all in, all out. You can do all over the time frame. You could do the whole calf, like the whole fall run. You could do disaster insurance. You could do top insurance. Like, the choices are endless. And when you say you have 250 cows, you could decide, really on paper, 100 of those cows are paid for. So I only need to insure, and 150, I'm willing to take the risk on 75. So I'm going to insure 75 at mid-range in case we have a wreck. Like, that's what you meant by cost protection. It's your own operation. You can tailor this for your own operation, however you see fit.
I love that. I'm just looking at, I had some very specific questions to make sure we cover it all. You don't have to buy on all animals. You don't. And I'm glad you nailed the pricing one, because I also spoke to Sandy Russell, who does cattle markets.
Yes.
As people always freak out because, exactly like you said, they look at the top price. Well, no, you can go more mid-range or whatever it is that makes sense for your cost of production, what you need to pay the bills, right?
People listen to her more because she's prettier than I am. And I see that at the meetings we go to. And they should listen to her, but they should also listen to me in saying that you need to think about risk mitigation.
Well, and you know what? Both of you guys, and that's why I brought her up, because people that lead in the industry, like you and Sandy and whoever that may be, are all sitting there going, what are you doing? Get price insurance, right? Get price insurance.
Well, for me, like I said, it's a bit of the psychology side of things, is that it's all we've wanted something to protect ourselves in the cattle industry. Now we have this, and there seems to be resistance. And there's resistance on different levels. Well, it's too expensive. Or the premiums on WLPIP are 100% paid by the producer. And agri insurance guys get that subsidy as far as cost share from the feds and the province. Well, we do get administration paid for this program from the taxpayer. And we didn't, it was sent to CCA. I mean, it was producers that decided we don't want to have subsidized or cost shared premium because of countervailing from the states. So there's a lot more reasons than just the simplistic, it's too expensive or this or that. I have told everyone, if you take the time to sit down with one of our representatives as far as WLPIP goes, understand the program, take the time and decide not to purchase, 100%, I respect that. But I dare say, I'll lay a case of beer on the table as a bet that you haven't taken the time to go through this program to see what it can offer you as far as a good protection for your farm. You've just heard from the coffee shop or you've heard from someone it's too expensive. But you don't. What's too expensive? Is $3 a head too expensive for disaster insurance? Come on.
I agree.
Maybe if the $40 is expensive, fine. I respect that. But there's somewhere in between that I think every operation could find something that they could swallow, that they could say, if I lose this, if that's what you consider it as losing because you're not getting paid, I'm with it. But like I said, every year your house doesn't burn down. Every year your truck doesn't roll. Every year that your house doesn't flood, do you say, geez, I wasted that. I'm going to tell Wawanesa or Red River, no, you guys are gangsters. You didn't pay me this year. You know what I mean?
Yeah. You just nailed the wording. I am a business owner ×2. So I own Farm Marketer and I also own a farm and I see all the farm programs. And honest to goodness, farmers are so fortunate with the programs they have. I don't want to give up a body part. I don't want to curse myself that way, but I would give anything in my non-agriculture business to be able to buy an insurance to put a floor on my income. When I start the year at Farm Marketer, I start at 0 in terms of advertising sales. That's how we monetize. I don't know. If nobody buys anything from me, I can have 0 sales. And there is no program I can go knock on somebody's door and say, why don't I insure my potential sales to make sure that I have a floor of 100% of my income, 50%? I would give anything to be able to do that on my Farm Marketer business. We're on the farm, between price insurance, between agri stability. My goodness, there's programs there to make sure that farmers have floors to their revenue. It's a bit mind-boggling.
One of the other things I think that we had criticism at the beginning, and I will accept that, but we have done everything that we can do, I feel, to try to accommodate the producer. One of the things was that the premium was 100% paid up front. Now you can charge the premium. You want to buy a policy, you can charge it, put it on an account. It's due 30 days after your policy expires. So the hope is that you should have had the cash flow to pay this policy. As well, WLPIP qualifies you. It's the only thing other than agri stability to qualify you for a cash advance. You can qualify for a cash advance with the WLPIP policy. So it's also opening other doors as far as I've seen it at the local credit union, at local financial FIs, financial institutions where, you have risk mitigation and they're looking favorably upon you because the bank knows, geez, our loan's probably going to be covered because at least if these cattle go like way down, at least he's got something or she's got something.
Yeah, I love it. I really enjoyed walking through that. Thank you.
Well,
and I'm hoping our audience finds it the same way. And it keeps on going back to that psychology too, because I see it with Anthony when he's buying. He's like, I'm going to wait. I'm going to see if it's cheaper. And then sometimes he's like, I waited too long. So there's this psychology. But at the end of the day, it's not easy. And I hate the word vulnerable I do. I think it's just overused these days. But even myself asking you those questions right here going, oh my gosh, I might ask Jason this and sound silly. It could be very easy for me to not ask. If we were having a quick conversation, there you are, I'm sitting down, and you walk me through and I go, oh my gosh, I don't really understand what this guy's saying, but I don't want him to think I'm silly, so I'm just going to nod. And then we wasted that conversation because I'm not willing to dig a little deeper and maybe look silly. And because of my ego, I hate to say it, I'm big on the psychology, but because of my ego, I'm afraid to ask those questions. I walk away and then I go, I don't understand it. I don't get it. I'm not doing it. And then my whole farm suffers because I can't ask the right questions.
Well, that's one of the things we struggle with as administrators at MASC. As what I do, I mean, I think I'm fairly observant of people, and I can tell when it's like, okay, like that little spiel we just did. It took 40 minutes, and you're still probably not sure, but. So we run the line of bombarding someone with too much information off the hop and not giving them enough so that they say, screw that, we're not participating in that. So we are always fighting with how we can get this message out to producers that, yeah, sounds complicated at the beginning, but once you get into it, it's easy. And but we're paid to help the producer understand it. So if you don't understand it, I consider it my fault. So that's why I think there's probably about 1,500, 2,000 business cards of mine with my cell phone that's in my back pocket all the time. And I mean, our agents are selling this program at MASC. But honestly, I'll take anyone's call, email, text, messenger, any time of the day, any day of the week. Because this is personal for me. I'm a producer. I take it personally. I take the criticism of the program personally too, which I got to talk to someone about, I guess. But
I can see that you get right offended. But hey, if you believe in your product, you do, right?
Yeah. So I guess what I'm trying to say is, don't write it off. Like I say, don't write it off before you understand this program inside out. And don't listen to the coffee shop. Well, we're not drinking coffee, but our number one fight has been the coffee shop. And I also say, don't take me and my criticism of the producer, because I'm criticizing myself as well, as condescending. I'm not being condescending. I'm just saying what I observe, and this is what it is, and if you don't like it, I apologize, but we have to step up as cattle producers and embrace a program that's being brought to us by taxpayers, which we are, I know, but if we want these programs to continue, we have to participate in them, and all you ever heard is, well, if this program would have been, where was it when BSE happened? If we had this program before BSE, no one would have bought it because nothing's going to happen. Now we've had BSE, we had the sharpest decline. We had a greater decline in the price of calves than BSE, and the producers that had policies realized that from the decline that they were paying upon. We've had COVID, we've had Trump, we've had these events, and it's scary. And I don't understand the producer that says, well, it'll be okay. I've gone through tougher times. Why go through tougher times if you got something to help you? I don't understand.
Again, I love the part where you keep on talking about psychology, because hold on here. Tony Robbins, he's a big self-help guru. He says business is 80% mindset, 20% strategy. So when we look at farm business, the mechanics are pretty simple. numbers are black and white, try and spend less than you make, those concepts. But the mindset and being able to dig in and learn and keep on top of these counterintuitive thoughts that we have, that's why I enjoyed where you brought up psychology first, because in some of my other risk management episodes I brought up psychology quite a bit.
Can I just mention one last thing, Tracy?
Right.
Is it I have this mindset too of as far as being it. You used to have to buy these policies online, while a lot of cattle producers aren't online. So we brought paper in. You can talk to your agent. The agent will fill it out. We'll get the signature from you. Anything that you could possibly think of, I think we have thought of as far as administrating this program, as far as making it easy for you to buy. The only other thing that we could do is that next step of not getting a signature, because we do have to get signatures. But once we get over that hoop, it's pretty much, as far as delivery, there's no excuses about how hard it is to buy, or I don't have computer access, or I don't get email, or I don't have this, or I don't have that, or I don't have the money. I think we've gone through every step to try to accommodate the producer. Now it's time for the producer to step up and say, and we've even extended the deadline here in 2020 because of this rec we've seen. So I don't know. Can we always improve? Yes, we can. But there is a very good program here for the producers if they take the time to get into it.
I completely agree. And I think we are really at the awareness and understanding stage for producers. So I am so thankful that you joined us on this show. Deadline, has it been for all of Western Canada? Has it been extended?
Yeah, we're at June 18th for Western Canada.
Okay.
You can always buy an Alberta policy as well. We have Alberta and Saskatchewan policies. Producers a lot don't know that. It's deadline June 18th. Feeder cattle, fed cattle, you can talk to us all year long about protecting them.
Okay, perfect.
And,
wow.
And you need to contact anyone. Look at our website, WLPIP.ca. Contact any MASC agency. Contact Portage Corporate Office for myself. And my email's jdobbin@masc.nb.ca. And we'll help you, or I'll help. If you're not getting any results for people you talk to, phone me. I'll take your call at 12 o'clock in a tractor seeding canola.
You're awesome. And thank you. I know you were seeding today, so I really appreciate you taking the time to help our producers out. And again, one last time, the WLPIP website would have all the provincial contacts, I assume, right?
It's under contacts. We'd have the provincial contacts, but our MASC website as well. If you take a little bit of initiative, you'll find us here. And
You're awesome. Well, happy seeding, Jason. Happy seeding to our audience. And I want to thank you for joining me, Jason. Once again, I appreciate your time and for bearing with me and walking through that. I really, really appreciated that. And
I'm sure we'll talk again, Tracy.
Yeah, I love it. I'm almost thinking of a follow-up. I have an idea, so stay tuned.
All right.
You might get another email from me. And for you that are watching, thank you for taking the time to join us. If you like the episode, like it, subscribe, and share it out there to other farmers that may benefit. Thank you for joining us, and see you next week. Bye.
You've been listening to Impact Farming. For more great episodes and articles designed to help you manage and grow your farming operation, head on over to farmmarketer.com. Don't forget to sign up while you're there. We will see you on the next episode.